So can you actually quit your job, retire, and just live off of dividends? Or is that just a pipe dream being sold on social media? In this video, we're going to unpack the real numbers behind living on passive income from dividend stocks and the realities of actually making that work for you and be sustainable. And spoiler alert, it's not as easy as just investing into high dividend yielding stocks and ETFs and hoping for the best. In this video, we'll start by breaking down exactly how much money you need invested to realistically make this work. Then we'll go through the 3 core factors that you need to consider if you're planning to go down this path. And finally, if you do want to go down the path of dividend investing, what's the crucial mistakes that you need to avoid and what you should be doing instead. So if you're planning to depend on dividends during retirement, then you'll want to stay till the end of the video. So let's dive into the numbers and figure out how much money you actually need invested. Now, if you're planning to live off of dividends, there are 2 questions that you need to answer. The first question is, how much income do you actually need per year to live off? Whilst everyone's numbers will be different based on their own personal lifestyles, ASFA have provided a benchmark, and if you're seeking a modest, comfortable retirement for couples, they've determined that the amount that you would need in terms of annual income is $73,875 as a couple. So for this example, let's just assume that that number is the answer to our first question. The second question is, what dividend yield are you expecting in order to hit that income goal? Now, Australian stocks are known to pay pretty high dividends. Now, based on a recent publication by the RBA, they actually analyzed that dividend yields were high through the 20th century, fluctuating around 6 to 7%. Now, to be on the conservative side, let's assume an average dividend yield of 5%. Now that we've answered both questions, we can now determine how much we would need invested, and to answer that, we would simply take our annual income of $73,875 and then divide that by the dividend yield of 5%, which would give us a total investment portfolio of $1,477,500, which is a pretty big number. So how do you get to an almost $1.5 million stock portfolio? Well, if you started investing $500 per month and continued investing $500 per month every month, assuming an average annual return of 10%, it would take you 32 years and 6 months to reach that portfolio. So yes, whilst it definitely is possible to build an investment portfolio large enough to generate you enough income to live off, it is going to take a very, very long time. Now, regardless of whether you decide to invest for dividends or you invest for growth, you'll need a brokerage platform. And that's where MOOMOO comes in. MOOMOO is a CHESS-sponsored, low-cost brokerage platform in Australia that allows you to invest into both the Australian and US markets. Trades start for as little as $3 per trade for Australian shares and 99 US cents per trade if you want to invest into the US market, excluding other pass-through fees and FX costs. If you are focused on dividend investing, then within the MOOMOO app, you can actually filter through the dividend rankings and then sort through companies based on those that pay the highest dividend yield. You can also look at companies that have had continuous growth in their dividend payouts, or if you're after companies that pay high franking credits, then you can also find those too. They also have a dividend calendar, so you can actually track your stocks and when you'll be receiving your dividends. Now, if you wanted to do more research into a particular company regarding its dividends, you can click on the dividend section within a particular stock to find key dividend metrics like its dividend yield, payout ratio, and franking rate. If you're a new customer and sign up and meet the requirements, then you can receive up to 38 free random fractional shares and also $2,000 worth of free brokerage card for both Australian and US stocks for 30 days, which basically means that your brokerage fees are free for the first 30 days. Now, if you're still keen on building a dividend portfolio, these are the 3 factors that you definitely need to consider before you go down this path. One of the big issues that doesn't get talked about enough in dividend investing videos that you need to consider is inflation. Inflation changes everything, and you have to be really careful when you talk about an annual passive income number. Look, $73,000 per year is a decent amount of money today, but in 10 20 or even 30 years, which is the amount of time it would take you to build up that portfolio, that $73,000 will become way less valuable. So if you want the same buying power of $73,000 per year, in 30 years time, you're actually looking at well over $100,000. We can actually work it out ourselves, and if we assumed a rate of inflation of 2% to $73,000 for 30 years, to have the same purchasing power in the future, our dividend portfolio would actually need to be generating $133,800. So yes, whilst you could start investing today in the hopes of building up an investment portfolio to generate you that $73,000 in the future, if you don't also take into consideration inflation, then it's not going to work out. Because like it or not, inflation is a part of our lives. For example, let's look at how inflation affects the stock market and more importantly, what it does to your money. If your great-grandparent invested $100 into the S&P 500 100 years ago and just left it, today it would have become $2.1 million. $100 into $2.1 million sounds amazing, but once you remove the effects of inflation, you get to the real return on your money. After inflation, the real returns of that $2.1 million is actually only worth $118,500. And that's because $100 in 1923 was a lot of money and is essentially equivalent to today's money to around $2,000. The second factor that you need to consider is that dividends aren't guaranteed. Dividends are profits that a company has made that are paid out at their discretion. Emphasis on the word discretion. It's not like a salary that is fixed in any way. This means that it can be risky to rely on dividends from individual companies or even a range of companies if you want this to eventually become the income that pays for all of your bills. Now, you might argue that this is why if you were going to invest for dividends, that you just want to pick the best blue chip companies in Australia that have been consistently paying dividends for decades. And whilst that strategy might seem logical, past performance is not a guarantee of future performance. And just because a company has had a good track record of consistently paying great dividends, it doesn't mean it's going to continue. The materials industry is one of Australia's biggest industries, as we export a lot of our commodities overseas to countries like China. But this sector can be known to be quite cyclical. In 2015, BHP paid a dividend of $1.40 per share during the China boom. However, only a year later, the dividend fell to just 29 cents per share, and it took 7 years for BHP to pay out a dividend of $1.40 again. And in a recent article published by CommSec, it highlighted that dividend payouts across the ASX have actually hit a 4-year low. The article estimates that the dividend yield for the S&P/ASX 200 index is at 3.7%, well below the long-time average of 4.5%. Even a high interest savings account has a higher yield than the Australian stock market right now, and it's a lot less risky. Now, a 0.8% decrease in the dividend yield of your investment portfolio might not sound like much just by itself, but on that same $1.5 million portfolio that we are depending on to pay us our annual income, that 0.8% decrease has resulted in $12,000 less income to spend throughout the year. So instead of $73,000, you would have $61,000 to last you the year. The last factor that you need to factor in are taxes. And this is more of a double-edged sword. Now, when you receive a dividend in Australia, you'll need to pay taxes at your marginal tax rate, regardless of whether you choose to automatically reinvest them or not. In the eyes of the ATO, that's still income that you're receiving each year, so they're gonna need a piece of it. So during your working years in your 20s, 30s, and 40s, when you're building up your investment portfolio, each year you'll be paying tax on the dividends that you receive. And as your portfolio grows and the dividends that you receive each year increases, the amount of taxes you'll pay also increases. Your working years are also going to be when your marginal tax rate is going to be at its highest, so focusing on investing into dividend paying stocks and ETFs aren't as tax efficient as compared to investing for growth. Now, in Australia, we do have franking credits, which essentially acts as a tax offset to ensure that the income you're receiving isn't taxed twice. You see, dividends are paid from company profits, meaning they've already been taxed once. And so franking credits are there to essentially offset the tax that's already been paid by the company. This means that in your later years, when you're retired, if your income is below the taxable threshold, the ATO will actually refund those franking credits in cash. And in many cases, retirees can actually boost their overall income by thousands simply through franking credit refunds. Now, not all companies pay franking credits. Some companies like Telstra and Commonwealth Bank do pay fully franked dividends, meaning you'll receive a credit to fully offset the taxes you've already paid, whilst others will pay a partially franked dividends and others don't pay any at all. So when selecting the stocks or ETFs that you might want to invest in, you want to pay close attention as to whether or not they also include a full or partial franking credit. And finally, what's the common mistakes to avoid as a dividend investor and what should you be doing instead? Now, a lot of investors focus solely on the dividend yield. And yes, whilst this is important because it tells you how much income you'll be receiving, but if that's all you're looking at and you're chasing the highest yields, you're setting yourself up for trouble. A great recent example of this was AGL. You can see from the blue line of this graph that the stock price of AGL has consistently fallen over this period of time. At the same time, the yield of AGL has actually gone quite up, reaching almost 14%. Now, if you're just focused on the dividend yield, you might think that this is a great investment. But what's the point of a high dividend yield if your existing capital within a particular stock is going to decrease over time? This is what's known as a yield trap, a stock that offers an unusually high dividend yield but is often unsustainable. It looks attractive on the surface, but the fundamentals just don't hold up, either resulting in future dividend cuts or the share price falling. So instead of just focusing on the dividend yield, these are the two metrics that you should actually pay closer attention to. The first is the payout ratio. This tells you how much of a company's earnings are being paid out as dividends. It's calculated by dividing the annual dividend per share by the company's earnings per share. So if a stock paid $3 in dividends and earned $6 per share, the payout ratio is 50%. The payout ratio is important to take note of because if the payout ratio is too high, analysts might actually question whether the dividend payout is sustainable or could hurt the company's future growth and even its stability over time, potentially causing the share price to fall. For most companies, a ratio between 30 and 50% is considered optimal. The second metric is the dividend growth rate. This actually shows how much of a company's dividend has increased over time, usually over the past 5 years. Dividend growth is actually extremely important because it means you're getting a pay rise every year just for holding that stock. So can you live off of dividends? Absolutely you can, but it's going to take a long time to get there. With all things, there are pros and cons, and hopefully I've shared some insight into some of those to help you determine whether or not this is the correct approach for you. Dividends will play an important role in investing, whether you like it or not. And even if your focus wasn't on dividends, if you simply owned a globally diversified ETF portfolio with Australian and international exposure, you'll still receive dividends each year. If you've enjoyed the video, then make sure to hit the like button down below and subscribe for more personal finance content in the future. And if you want to know what the optimal order to invest is, then you might want to check out this video right here. Otherwise, hopefully I'll see you in a future video. As always, thanks for watching.